but as you say, if you just tackle each boulder at a time, it makes it a lot more bearable. So good to see you guys, although I can't really see all of you that much, but today we've obviously got a lot to cover, so I'm going to get started quite quickly. But if you've got questions as we go, there should be a way to let me know, shouldn't you? Feel free to intervene and unmute yourself and ask, but hopefully it should be quite clear. But I'd rather you ask the question than it go throughout the presentation. It not really makes sense for you. Managing...
Kate, you probably won't be able to see them raising their hand, of course. Yeah, do just unmute yourselves if you do want to ask Kate a question, because when you're in presenter slide mode, you can't always see those hands raised.
Precisely. So yeah, just literally unmute yourself and ask the question. So there's a lot to cover, but a big chunk of this is about helping you understand how it all fits together. You know, you could outsource somebody to do your finances, you could do it yourself and not understand, but if you don't have that understanding, you're not going to be able to properly manage your finances. So today I'm going to cover the basics of bookkeeping and how you use that to record financial transactions in your business. And then I'm going to show you how these transactions then flow into your financial statements. So that's your profit and loss, your balance sheet and your cash flow. I'm not expecting you to be an expert, and it is complex topics, so I'm going to try and simplify it as much as I can. But as I say, this is about understanding and making sure you see how it flows. I think a lot of people will end up using bookkeeping software, and they may still use spreadsheet early days, so this is why it's really important. So we will cover what kind of options you could use to help with the bookkeeping. We'll also talk about why it's important to manage your finances and how to do this effectively. As part of that, we're going to spend some time talking about financial projections, which should help you with your business plans. So I'll touch on the spreadsheet I've already shared with you, but hopefully it will give you a bit more confidence to draft your financial projections. And then we'll explore what actions you can take to manage your cash effectively, because cash is one of the most important things for your business. And finally, we'll wrap up finding out about more different funding sources as and when you do need that extra support with cash. So what's bookkeeping? Officially, bookkeeping is recording and keeping track of all the financial transactions and affairs of your business. So what I mean by financial transactions, it could be anything. So for example, if you sell something to a customer, you will raise a sales invoice or sales receipt, and then they pay you and you'll record this sales invoice is paid. All of those things are financial transactions. What else? Sorry, I've moved far too quickly. Things like liaising with HMRC and doing a VAT return, or paying any tax due, or paying employees, or taking out a loan. So why is bookkeeping important? It's important for a number of reasons. First of all, it helps you to understand how well your business is performing, both in terms of sales and how much you're spending. It also helps give you a view of your current financial position at a point in time. So what you owe people, how much people owe you, and how much cash you have in the business. It can be used to help get information to help you borrow money or raise finance. It can help with decision making, for example, knowing when is the right time to invest or to buy a big piece of equipment or take advantages of opportunities you might have seen in the market. It also, keeping proper accounting records is a must, not only for things like tax compliance, but also if you're a limited company, it's one of your duties as a director. And critically, to help make sure you manage your finances and your cash. So this is the sort of very dull bit of this slide, really. In order to properly implement bookkeeping, you have to work out what kind of accounting method you're supposed to adopt. And there are two bases of accounting that people refer to. One is called cash accounting and one is accruals. The difference between these types of accounting is based on the timing as to when the company records sales or purchases in the accounts. So if you're using cash basis, you recognise your sale as and when you receive money from someone, and you recognise purchases as and when you pay someone. But with the accruals basis, the sale is recognised at the date the transaction occurs. So for simplicity purposes, when you receive an invoice from someone, or when you raise an invoice, technically it's not quite so black and white like that. It usually is, you should be recognising revenue and costs when you've got that obligation has been fulfilled. So say somebody orders something for you, the point at which you recognise that sale might be when you deliver the item to the customer. But as you can see, it's a timing difference. One is about cash and one is not. The difference we've got
is... Can I ask a question?
Push cab.
Sorry, is this some schools send me like a remittance order? Not, is it a remittance order? A purchase order? Is that does that fall into that second category?
Yeah, so again, it's a fine line, and there'll be sometimes, and this is why it's about sometimes you might have to get advice, but a purchase order, quite often people will recognise the expense at that point because you've made that commitment to incur that cost.
Yeah, that was my understanding.
Yeah, so you could argue, well, I haven't received it yet, but actually, if you were doing very detailed and proper accounting records, even if you hadn't received the invoice for it, you would accrue for that. You'd recognise that cost in your accounts and accrue, knowing that there will be an invoice to come, and you then pay. But yes, basically, it's when that obligation to pay kicks in, really. So
it's sort of like a base form, sort of almost an agreement, isn't it? It's to say that they can sort of account for that money expenditure. Because for me, it doesn't make it. I don't think for me it makes any difference. But there's some schools want it and some schools don't. And I was just wondering how that would apply. I'm assuming that's because it's that second.
That is exactly what it is. Yeah, precisely.
Okay.
So.
Sorry.
No, that's fine. Great question. And that's the whole point. It's about putting a lot of this into context as to why it's relevant and why it matters. If you're a sole trader and your revenue is less than £150,000, you can use the cash basis. So that means it helps out small businesses that, you don't want to get to that complication. You can literally have an Excel spreadsheet and say, this is what's happened in my bank. Money's come in, it's a sale, money's come out, it's an expense. And it makes life a lot simpler. But if you're sole trader, you make more than £150,000 of sales in a business, you lose that ability to use cash basis and you have to use accrual basis. And then if you're a limited company, you have to use accruals basis. And this is all to do with basically accounting standards. So it's not something that HMRC has done. It's just it's set like this. So you've got a comparable. So if you've got 4 businesses side by side, you know that people are using the same way to recognise their sales and costs. Right. So as I say, the accruals basis is slightly more complicated, but what it does is it does actually give you a more accurate position of your financial position. So with a cash basis, you might say I've recognised sales and expenses, but nowhere have you got a list of saying I owe this many people, these suppliers, or this many customers owe me money. Whereas on the accruals basis, you can have a list that says I'm owed £5,000 by these customers. So as a result, that means it better helps you manage your cash flow. So whenever you record a financial transaction, there are 2 sides to every entry, and this is what's known as double entry bookkeeping, which I'm sure most people have heard of at some point in time. So what double entry bookkeeping is that there's 2 sides to that financial transaction. One side is called a debit and the other is a credit. Now, understanding bookkeeping isn't an easy task and not something I'm going to be able to teach you in this masterclass. But this table summarises the items that you typically be debited or credited in your accounts. And you can remember this by remembering the acronym DEDCLIC. So anything under the DED column would something be typically debited, although you can debit and credit. And anything under the CLIC column would be credited. A lot of people get confused because they quite often look at bank accounts and say, well, hang on a minute, why has my bank account got a debit? But actually, the bank account is looking at it from their point of view. So if you've got a bank account which is overdrawn, it will show as debit, and that's because it is money that is owed to the bank. So within here, we've got DEDCLIC. So anything that's an expense or an asset, so something you might have bought in turn. Oops, we've just fast forwarded. You buy a computer or something like that, or anything, if people owe you money, that would be a debtor, and that would be a debit. And CLIC would be if you owe money, if you recognise any income, or if you recognise you've got a loan agreement, for example, things like that would all be credits. Okay, and I'll explain in a bit more detail in the next slide so you can put it into context. You might hear some people mention single-sided entry, but technically there are still 2 sides. It's just that the other side is cash. So that's something that would apply with cash accounting. So as an example of what a double entry might look like, I've used a couple of examples, whether you're a limited company or a sole trader using the cash basis, just to sort of try and show you what I mean. If you raise a sales invoice and you're a limited company, so just look at the left-hand column, what would happen is you would recognise the sale, and that would be recognised as a credit because it comes under the click column, and the other side would be the debtors. That's people that owe you money, right? As and when you receive money from that customer, there's another double entry that takes place. So first of all, you get the money into your bank, and then you can see that that debtor is reduced by the same £100. So they no longer owe you the money, and you've got the money in the account. At the same time, if you're a sole trader, that first transaction would never happen. So you would only recognise one transaction when you receive payment, and that would just be a simple debit bank, credit sales. Does that make sense? Any questions on that? No, that's a good sign. And it's a similar thing on the supply side. It's just completely into reverse. All right. So each and every transaction you recognise in your account should be supported by a document that describes the business transactions. So, for example, a purchase invoice or receipt would be something that would be considered supporting documentation for an expense you've incurred. Or if you've got a loan agreement, that would support things like your liability of the loan you've taken out, how much you're going to be paying every month, and the interest that's charged. As I said before, if you're a limited company, one of the direct duties of the director is to keep proper accounts and records. So, and they're also needed for tax purposes. So just encourage you to make sure you've always got a copy of all your bookkeeping records. So whether you keep it in a folder, whether you keep it in a cardboard box, it's completely up to you. But just make sure you've got that copy. If it's ever required, then you've got that information. Technically, you can be penalised.
Okay.
Yep.
I'll ask a question about that. So I've been trying to keep the actual document, you know, the invoice or whatever,
yep.
when I'm spending money. But if it's all going through the bank and the bank is hooked up to your accounting software and you're reporting off your accounting software, is that proof enough? Do you need to keep all of these little bits of paper for every transaction when you're buying online, it's coming through to your bank?
So yeah, so let's think about it this way. You would have you'd have a trail that the money's been spent on the bank, but the first thing that somebody could say is, well, what is that expense that you've incurred? Is it actually a business transaction? Is it something, and it, you know, is there a tax implication on it? Is it something that, you know, it's allowable for tax, or is it something that's not allowable for tax? So really, that's the reason why you have that support. Or say, for example, you recognised an expense. I'm going to throw out an expense of £10,000. Okay. That £10,000 may be not something that, it may be for some reason you're not supposed to recognise it in that month that you've recognised it in. So say, for example, you've got some really expensive insurance. That £10,000 should in theory be spread out across the year or a couple of years, for example. So it helps support why you've recognised that expense at that period of time. But without that, you don't have that support. Does that make sense?
Yeah.
And yes, if you're using accounting software, it gives you the option to add your receipts, which is great.
Yeah.
And I encourage people to do that, because as and when you get bigger, if you've got somebody else doing your records, let's say worst case scenario, HMRC says, oh, we're doing a random check, we'd like to look at your accounts. If you've got to suddenly dig out all the receipts that you don't have in your accounting system because you've got it in your backup on your computer, or you've got it in a box, you have to stop doing what you're doing and stop running your business and give HMRC all the information they need, because your accountant can't do it or your bookkeeper can't do it. It's only you that can do it. So clearly having that information in the accounting software is great. At the same time, I always recommend people have a second copy. So if you have it just in your accounting software and you don't have a copy in your hard drive or something like that, the risk that you've got there is, say, for example, the accounting software goes into, becomes back, administration, and they cease to exist. And it may be that you lose all the information. I mean, there'd be issues, but you've got that backup, it doesn't matter, because at least you've kept those separate records. So that's something that I would recommend to people, just to make sure you've got that, really. that okay?
Yeah, I think so. Yeah. Just to use an example, just to go down to the silly level of, I buy a poster from a well-known printer, and that's recorded. It's still recommended, even in that case where it's obvious where the transactions come from, what the money's been spent on.
Yeah.
That invoice is then saved in multiple places in the accounting software and on.
Yeah, it just makes sense, and it's when I'm looking at people's accounts, I'm quite often I'll see an amount, think, well, what's that? And then by looking at that invoice, I can see that they've misposted something, or it needs correcting, or actually it's not a business cost, it's a personal cost, and maybe that's why some people do not include their receipts, so that they can, But in all honesty, there's a few examples here. So, for example, if you claim mileage, technically you're supposed to keep a mileage log. So you're supposed to have a log say, I went from here to here, and this was the journey. So again, it's just about sort of providing that support. And it's, if you don't have that information, HMRC has got more chance of turning around and saying, do you know what, I don't think it's a business cost, because you can't prove it. And therefore the onus is down onto you to be able to get that information. And, it becomes more important, again, when you're VAT registered. But, don't get me wrong, you don't have to have every receipt. So if you park somewhere, you don't have a parking receipt, it's not a big deal. But by and large, just get into that system of recording things in the right way, and then it doesn't become a big hassle as you move on. All right.
Hey, sorry, can I just interject? Because Clive, I think, is he still with us? Because it keeps coming. So Clive keeps trying to join, and he keeps getting knocked out again. So when he does join, can you just sort of explain to him? I'll try and email him as well. And if he wants to ask you a question that he needs to just say it out loud, I'll try and email that to him as well. But he was in 2 seconds ago and he's gone again.
I was going to say I admitted him, and then he said, okay. I assumed he was online. Brilliant. Okay, so there are different options to keep track of your bookkeeping. Okay, if you've got a simple business and you're not making much money and you're not VAT registered, then starting off with paper records or an Excel spreadsheet is completely fine. Especially if you're a sole trader using a cash basis. I've got lots of clients that, they have an Excel spreadsheet and they keep track of it. That's historically how things were always done. But the problem with this is it becomes a bit more time intensive. It's prone to error. And unless you are creating financial statements that are automatically linked to this an Excel spreadsheet, you're not going to be able to manage your finance effectively, because you're only looking at your accounts at the end of the year. So a lot of people come along and say, oh, I didn't know I owed this much money, or I didn't know I was going to have this tax bill, because they're literally not keeping track of things throughout the year. And the whole point is you should be managing your finances throughout the year. Okay. Banking apps give the opportunity to add receipts and categorise your transactions. But again, I think it's only really an option if you're a sole trader and using the cash basis, because again, it doesn't give you those financial reports, and it doesn't give you the option to see how you're performing, or show you how much you owe people, or allow you to file VAT returns. So really, if you want to effectively manage your finances, using something like an accounting or bookkeeping software package is the best option. Apologies about the font on the slide, by the way. As long as you're, we've lost Katie as well. Just let Katie in. So as long as you keep on top of your bookkeeping, you'll be able to see at a glance at any point in time how you're performing, or who owes you, or what you owe other people. And that's the crucial thing, really. In time, you will ultimately need accounting software anyway. So if you need to get VAT registered, you have to have accounting software, because that's the only way that HMRC will accept VAT returns these days. And they're also, that's part of their Making Tax Digital campaign, but they're also moving towards filing for corporation tax online. So in a few years it will be given, and it's the same if you're a sole trader. Ultimately, they're introducing Making Tax Digital for income tax, and I'm not even going to quote the date because they keep moving it back, but that was supposed to have been kicking in from April next year, but it has been delayed. So right, so in terms of bookkeeping software, effectively there's a buyer's market. There are loads of people out there. There are also lots of free options, and the free options might be all you need. But it really does depend on the size, type and complexity of your business. And it might be that you prefer to pay for an option that is maybe more intuitive to use, something that might provide integration to another piece of software you use. Maybe that's a stock management software, or something that has automatic bank feeds. And so before you choose the cheapest option, just make sure you compare the different features that are available. Can you do reporting on there? You know, do you have the ability to budget and forecast? Again, that's not critical. A lot of people I know still do that in Excel. So it's not a be and all and end all, but it's what's going to work for you. And once you've compared, always ask for recommendations. Speak to other people. What do they use? What do they like? What don't they like? I had a client who was hell bent on changing to a piece of software, which I don't think I've included here, called Cashflow. And he was absolutely adamant, this is what I need to do. It's really cheap. And he kept saying, it's really cheap. And I went back to him and said, does it do X? 1 second. Just let Clive in. Hi, Clive, are you there? I'll let Steve in as well. Steve, are you there?
Yes, I am, yes.
Hiya, just a really quick, what I've said to the guys is if you've got any questions as we go along, because you can't raise your hand, just turn yourself off. Everyone's on mute, but if you need to ask a question, just turn off mute and just interrupt me, okay?
Okay, no problem. Thanks.
Perfect, brilliant. So we just talk about software. Anyway, so he wanted to use this piece of software, was absolutely adamant, and it was all about costs until I pointed out that actually in reality, it wasn't going to do half the things he needed. So he went back to square one again and stuck with what he was previously using. So as I say, it has to be something that works for you. So
I've got a tip on I joined something called Metal, which is one of these new online app bank account, business bank accounts, and they give you I think it's Free Agent.
Yeah.
Oh, I did for free, which is for a year or something.
Yeah, so if you're NatWest customer, that should have been on the list. So Free Agent is a piece of software. If you're NatWest customer, you get it for free. So I don't know about you, but we've got Metal as an additional bank account that we set up for our taxes. So that's great because actually it's not necessarily, so if you've already got a bank account set up, you could say I'm going to set up Metal because I'm going to use that for my savings, and then you get free software out of it. But again, you might find that you don't like Free Agent or something else. But yeah, just say it's a great tip. But make sure that you like how it works, because if 12 months down the line you're not happy with it, you've then got to go and find something else when you start paying for it. Great.
But one of the things as well I like about MetalK, I was going to say, is that the account software that just brings in your transaction from your bank account, I think is worth its weight in gold.
Exactly. It's that used to be the biggest problem that businesses had. They used to sort of say, oh, they literally have a spreadsheet and they'd look at their bank and go in and say, well, I've incurred this cost, and it would just be replicating the bank statements. Pretty much all the accounts, I say pretty much, there's one or two that I think don't, but the ones I listed did. They feed in your bank statement automatically, and what happens is effectively it's sitting in this bank reconciliation tab, and the idea is that you're then supposed to match them and say this is what it relates to. So in theory, if you're doing your accounting records properly, you've already got your invoices in the system, and the idea is that you then match them together, and then you know that you've covered all the transactions in there. So brilliant. There is, just to let you know, there's a coffee break scheduled because I know you're going to need this, but I'm going to carry on talking for a little bit longer. So we've covered bookkeeping and why that's needed. What I'm going to do now is look at how our financial statements are derived from these financial records. Okay, so in this diagram, you can see we've got transactions at the top, and at the bottom here, we've got our financial statements. So these are needed to help you understand your current financial position and see how well you're performing. So all these transactions are recorded using double entry bookkeeping, which is sometimes referred to like a journal. Okay, and by doing that, each journal is posting them to different account codes within your company's ledger. And when I say ledger, you'll hear lots of different terminology like nominal ledger, general ledger, trial balance. These terms technically, if we go into very detailed bookkeeping, are technically different. But for the level that we're talking right now, the terms are used interchangeably, and in the most simplest form, I think they're the same. Okay. So items in your ledger are then split out between things like revenue and sales. So revenue, sales and turnover, all the same thing. Expenses, assets and liabilities. I'll come back to what these are in a minute. And then you've got your capital and reserves, which is also referred to as equity. Okay. And then those items then get converted into your income statement or profit and loss, balance sheet, and then the two together effectively help form a cash flow statement. Right. So as an example, this is an example of a trial balance for ABC Limited. Okay, so you can see they've got the list of all the account codes, and these are split out into financial statements. So the top half, which covers things like your revenue, your costs of sales and your operating expenses, all go into the profit and loss. Okay, and the bottom half of the trial balance, things like your bank and current and fixed assets and liabilities and equity, all go into your balance sheet. And what you'll see at the bottom, you've got these debits here and the credits. And if you look at the bottom of the right-hand column, you'll see it comes to zero. And that's because the sum of the debits and the credit entries will always come to zero. Okay. So if for some reason your trial balance doesn't agree, it should never feasibly be possible. But if it doesn't agree, there's something going on in the background. All right. So profit and loss. So the profit and loss or income statement provides you with an overview as to how your performance has, how your business has performed over a set period of time. So it might be a month, a quarter, a year, etc. So the format of a profit and loss might vary depending on the level of detail that you include or the terminology you use. Okay, so really different, but effectively revenue, turnover and sales are used interchangeably. If we're getting really fussy, sales might be the revenue you make as a result of selling products or services, but you might get other revenue from, for example, interest that you've earned. That would be deemed as other revenue, or you might have received grant income. That would be other revenue as opposed to sales. Okay, and then you've got something called costs of sales, and they are purchases that directly relate to the product or the service that you've sold. Okay, and the net between those two creates your gross profit. And then beneath that, we've got either administrative costs or operating costs, which you might break down to things like staff costs, property costs, etc. And you take that away from the gross profit to give you an income profit. In fact, I've got interest income at the bottom here. So then you have your profit or loss on ordinary activities before taxation. Then you have your corporation tax, and you have profit after tax. I've included EBITDA in here. So EBITDA is it's not something that's included as part of your standard profit and loss, but it's invariably something that investors look at. And they do that to help standardize when they're comparing businesses, and it effectively represents your operating profit, your profit before any interest, tax, depreciation, amortization. So it's really just to understand how is your business performed on the standard ordinary activities. Okay. Yes, so the difference between income statement and profit and loss, it literally is a change of accounting standards where income statements were brought in. But for the purposes of what I'm talking about now, I'm just going to refer to profit and loss. It's a terminology that a lot of people continue to use, makes it easy to understand. So your balance sheet provides you with an overview of your current financial position at a set period in time. So the format of a balance sheet might be subject to the level of detail included again. So it summarises your assets, the top half, your liabilities, and at the bottom we've got our capital reserves. So an asset is something that can be converted into cash. So that's something when we refer to liquid assets, or something that can help generate future economic benefit. So for example, a debtor is an asset because it is somebody that owes you money. So in the future, you will get money from that debtor. And as a fixed asset like a computer, or a piece of machinery would be deemed an asset because they help you to produce your goods that you need, or it's something that in the future you could sell and you would make money from. Liabilities on the other side of things, cash or things that you owe to someone else, or something that you will need to pay in the future point in time. And they're normally split out between current and non-current. And it's important you've got that split, because if somebody's looking at your balance sheet and you've got all your liabilities under current liabilities, but actually you've got a loan that isn't due back for 5 years, you could completely misinterpret the position of the business. So Fixed assets. When you buy fixed assets like computer equipment and office equipment, this is referred to as capital expenditure, or CapEx for short, okay? And when you buy something like that, you should be recognising, assuming you're a limited company, not a sole trader, you should be recognising it in your balance sheet. And all of this, if you're a sole trader in a cash-based business, you wouldn't have a balance sheet, okay? That's quite an important thing to realise. So if you bought a computer, you put it in the accounts as an asset, and what you do is you then spread the cost out over the period that you expect to use that computer. So if you buy a computer, you think it's going to last 4 years, you would depreciate it. So you'd split that cost into, say, 4 years, and every year you'd recognise a quarter of that cost in your profit and loss as depreciation. So very, go into a bit more detail, but it just helps understand that. Okay, so
did you say, sorry, did you say
yeah,
that if you're a sole trader you don't need to do that?
if you're a sole trader, technically you don't have a balance. If you're used the cash basis, you technically wouldn't have a balance sheet. I mean, you'd have cash, you'd have a bank account, but that's the only thing, because you're not recognising the assets or liabilities.
Right, okay, that's what I thought.
And
the only reason I asked that is because I recently bought a laptop, or I bought some computer equipment, and I am still as a sole trader, but I am in that thought process of registering as a company and then probably changing it so it makes, I'm not entirely sure what type of accounting I need to do, but I think that's sort of
basically, sole traders, the idea is that they're trying to make life easy for you, so you can just recognise it. So if you bought a computer as a sole trader, it would just be treated as an expense in your accounts, and it just comes as a profit this year. From a tax perspective, it's exactly the same, because a business claims its capital allowance, but it's just how it's accounted for. And it's, again, it's about people being able to look at someone's accounts and say, right, let's compare this business. And
am I right in thinking it's almost like writing it off in 1 year, isn't it? It's saying I bought this computer or this thing this year, so therefore, I don't know, let's say it was a computer, printer, stationery stuff for £2,000. I just claim that as an expense off that year. Whereas if you're using the other basis, it's almost that you have that asset for 5 years, 6 years, whatever, and it potentially depreciates over time, and you can. Is that right?
That is, and the reason they do that, the whole point of this whole accruals basis is that if you had a business and you had all these ups and downs just because you were investing in equipment to help grow your business, it doesn't give you a true position of how you're performing as a business. So if you make, let's say you made profit £10,000, but you bought a big, bit of machinery. So, using Adam and Neil as an example, if they bought lots of equipment for their drink, they'd be shown as loss making. Well, technically they're not loss making, and actually that is an investment they've made for something that's going to be used in the future to continue producing the product. So it's just to sort of normalise things and actually give a fair representation of that business performance. Okay, so the cash flow statement, or statement of cash flows, is the third and final statement we're going to look at. And this is used to help business owners understand how they are spending cash in their business, which might seem really obvious, but actually sometimes it's not. So, and they're a really good indicator of financial health for an external stakeholder like a bank or an investor. Okay, so cash flow statement are technically made up of 3 components. You've got cash from operating activities, cash from investing activities, and cash from financing activities. So operating activities relate to all the normal day-to-day operations of the business. Okay, so they include all the things you see in your profit and loss, like revenue and all the costs. Okay, investing activities represent activities on short and long-term investment in growth. So it might be buying those fixed assets, the equipment, machinery, or it might be buying loads of stock that you need to sell, etc. Financing activities relate to cash to and from any investors or banks. So if you've got a loan, it will relate to money that you receive from the bank and then the subsequent drawdowns. It will relate to any dividends that you pay to a shareholder, any shares that you issue or repurchase. And so that's that. And to calculate your cash flow from financing activities and investing activities, you need to calculate the movement between your balance sheet, because it's not something you can see in your profit and loss. It's the operating activities you can see from there, but I'll talk through in a bit more detail how it's put together in a second. So, for example, if your fixed assets have increased because you bought a new piece of machinery, that gets recorded as a cash outflow because you've spent money on that item. At the same time, say for example, you raise an invoice to someone and they don't pay you until next month, you would see a cash outflow on the operating activities because you've not received the money that you should have received because you're receiving it next month. Okay, so cash on operating activities. So when you calculate your cash on operating activities, and again, this is really high level, and if you're using a bit of accounting software, half this information will be in there. So another reason why it helps to have it. There are two methods of calculating cash on operating activities. So you've got the direct method and the indirect method. Okay, the direct method is the most simplest method, and it basically summarises all the cash you're getting in from customers and the cash you're paying out on suppliers, employees, or any other operating expenses. And this is typically, if you're using the cash basis for accounting, this is typically what you use. Having said that, I use Xero in a lot of my sort of accounts. The cash flow method they provide for people is actually a direct method, even though it's an accruals basis. And they do that because it's a much easier way for an individual business owner to understand where their money's going from. Okay, the indirect method is slightly more different, you see, because if you look at the top, you've got operating activities. On the right-hand side, you start with the net income or your net profit that you see in the profit and loss, this 50,000, but then you have to adjust back for all the items that either aren't in the profit and loss or non-cash items. So you might take out things like depreciation or any movement in current assets. So it makes it a little bit more complicated having to think about. And I appreciate it probably blows your mind, but as I say, accounting software now usually will show you how your money is being spent and where the cash is going. All right. So, but as you can see, these two different cash flow methods, they both end up with a net cash flows from operating activities of £49,000. And thereafter, the cash flow on investing activities and financial activities are the same. And at the bottom part of the cash flow, you can see you've got your total net cash flow of minus 1197.65. So overall, that much has gone out of the business. And the bottom summarises the cash that you started at the beginning of the period, the cash outflow, and therefore the cash going out. That doesn't agree in balance, by the way. As you can see, 7,000 minus 1 is not that figure, but that was just for illustrative purposes. So, so this might all seem quite complex, and that's the point where you might think, actually, I can't do this. I'm going to get some accounting software. You might decide to outsource it, or you might decide to outsource, get someone to give you a bit of advice, and then you can carry on do it yourself. But as you grow, as your business gets more complicated, there'll be decisions you need to make. Does it make sense for you to keep doing it yourself or not? And that is actually quite a key decision as financial management. If you're spending all your time running your business and not looking at the finances, that's when you're going to get into trouble, because you need to spend the time managing those finances. Right, so there's a very few more slides and then it's going to be coffee break, okay? So I hope you're all doing okay. So I'm going to briefly start by talking about what financial management is and what it covers. So as I've mentioned, keeping your bookkeeping, accurate and timely bookkeeping is critical if you want to ensure you can manage your finances efficiently. Okay, financial management can be defined as the procedures involved in planning, raising, controlling and administering how your company uses its cash to help achieve the goals and objectives of the business. Okay, a nice sort of diagram there. So the main objective is to maximise profit and shareholder value, ensure your business survives, reduce any risks, and at the same time take advantage of relevant opportunities when you can. Ensure you're compliant with any tax and legal obligations, ensure you manage your cash flow effectively, and maximising operational efficiency. So as a startup, there's going to be four main things you do to manage your finance effectively. So one is set realistic budgets and forecasts that align with your business plan. And that's what I've been alluding to in our one-to-ones. The next thing you'd be doing is comparing how your business has performed, the actual performance. You compare that to what you were budgeting or forecasting to be. And where you've got those variations, if there's something you need to take action, you then need to take that action as and when required. And obviously making sure you've got an effective system of managing your cash so you don't run out of cash. So to do all this properly, you need to ensure your bookkeeping is up to date and you record your transactions accurately as you go not just as a catch up at the end of the year. Okay, so once you've got these basics in place, it's just a question of doing this ongoing cycle: plan, allocate your resources, monitor, see how you're doing. Is it how expected? No, let's replan. It's just a perpetual thing. It's not supposed to be a big deal. It's just recognizing if something moves. So we're going to come back to budgets and forecasts when we look at financial projections and after the coffee break. But just before that, I want to talk through how you might analyse and evaluate your company's business performance and the subsequent actions that might follow. Okay, so we start by analysing financial statements. And this is usually done by looking at things, variance analysis, ratio analysis, and trend analysis. There's no right and wrong way. Every business is different. I know lots of businesses that don't really analyse, use all ratios. Investors do. A lot of people don't bother. They just look at variances and trends. So how and what you analyse will vary depending on what your business is doing, what the current financial position is and how it's performing. So if your business is in a startup situation, there might be things more related to making sure that you're managing your cash properly. Or it might be that actually you're trying to grow because you want to invest. It might be critical for you to be driving revenue. So if your revenue is not as high, that might be your focus. But the important thing is to focus on what's going to help you understand your business. You then need to ask yourself what the analysis shows and investigate what it requires. As I say, you then need to work out what actions you need to do and reforecast to reflect the trends. So if you can see that your sales are dropping, you need to reforecast to reflect that and then work out what you need to do. How does that flow into your cash flow? Do you need to take any other actions like cut back costs, for example? Right, so an example of variance analysis, lots of numbers on here, but it was just an example of a profit and loss and comparing current month, year to date, and full year forecast with a bit of narrative on the side. So I'm not going to go into the detail. I'm just going to talk through really what's happening. So when you do variance analysis, you're generally comparing, we could be comparing to anything. In this diagram, I'm showing that you'd be comparing, say, for example, your actual performance versus forecast. Just to back step a second, if you a budget, basically something you set at the start of the year, and it's usually created by looking at what your known costs are and then adding in revenue that you expect to make. But they're static, they don't change, certainly not for a year. Whereas forecasts are supposed to be something that change when new information comes to light. So at the start of the year, your budget and your forecast will be exactly the same. But as the months move on and changing trends happen, I would expect your forecast to adjust accordingly. Or if there's any change you make in your business strategy, for example, you decide to introduce a new product line, you'd expect those sales to change. So I normally recommend that if you're looking at your current month, I'd compare to forecast, because the forecast is the most recent expectation of how you expected your business to perform in this month. Whereas if we're looking at November and comparing to budget, well, that was 11 months ago, for example. So you get the situation. Year to date, I tend to look at actual versus budget, and forecast. Full year, I look at the forecast versus the budget. So the forecast for the full year might be your actual to date plus the forecast for the year. It could be your variance analysis compares current month versus last month, or current year versus last year. So you can look at it lots of different ways. As I say, it's what's going to give you the information to let you understand the business. Okay, but by doing this, you can determine how far off track you are. So if you were expecting to make revenue of £6,000 and you've only made £4,000, why? Is it because your forecast was unrealistic? Is it because it's just delayed back and you're going to have twice the number of sales next month? You sort of need to understand why that is. And just if something doesn't look like it should do, just make sure you understand and find out whether it's something that needs actioning. Other things I've noted here, so for example, just as an example, I've looked at sales and said that sales are down 31% for the current month, and year to date they're down 37%. So to me, that suggests your sales are on a downward trend. So as a result, I updated the forecast to reflect that. So I've reduced this forecast to £45,000. The cost of sale, these seem to be on target every month or in the current month, but because your sales are down, you'd normally expect your cost of sales to be down. So it's something you'd be sort of looking at, actually, why is that? Is it costing us more to produce something? And then other things you might look at, staff costs, if they're slightly over what you expect us, then, is that a problem? But year to date, they're not, so it's not a problem. Depreciation, for example, I can see there's nothing being recognised here, but we've had it in the budget. So that means that you haven't recognised your depreciation during the year. Other things that we might look at or come to margins, but I've included some ratio analysis in here. So things that are good to look at is your gross profit as a percentage of your sales, which is known as your gross margin. And you can compare that. So even if your revenue and costs are up and down, this is a good way of seeing how you perform. And likewise, your operating profits. So just a few things. Right. So we are nearly there. Coffee break. Now, ratio analysis, I think a lot of it will blow your mind, and I wouldn't necessarily say you need to look at this, but it's just a way of, it's a common technique of comparing the relationship between two or more items of financial data. They're typically split between 5 main areas. So liquidity ratios measure a company's capacity to meet its short-term debt obligations. Profitability measures, measures how profitability ratios measure how efficient you are in generating profit using your cash over a set period of time. So obviously a better ratio means you're more efficient in how you do things. Leverage ratios measure how much debt a company has, and market value ratios are things that people use to work out how valuable a company is. And this is typically something that might be used by an investor. So I'm not going to go into the detail. It's just telling you that it exists. If it's something you'd like to find out more about, let me know and I can send something through to you. But equally, it's something that you can look up online and find out more about. But I typically expect businesses to look at a bit of both. So the gross margin, for example, is something that people do. Depending on what you do, debtor days might be another ratio that's relevant to your business. But again, it's not, ratio analysis is something that's quite cumbersome. So unless you've got something in a spreadsheet that links to pre-calculated formulas, it's something that you then have to manually do. So if you're going to do something like that, make sure that you make it easy to do, not something that you forget about or don't have time to do. And the final thing that you might look at is trend analysis. So by comparing your actual to forecast on a month-by-month basis, you can quickly identify if there's a change in activity. So in this graph, we've got our budget revenue, the forecast revenue, and the actual. And we can see that actual sales are significantly down versus our budget. We can also see that we're not very good at forecasting because the actuals are down versus the forecast. So armed with this information, it'd be reasonable to assume that you haven't, we need to understand why the sales have changed. Is it because our revenue forecast has been unrealistic or something happened in terms of selling? Okay, but if you overstate your sales, the biggest risk is that you overstate how much cash you think you're going to have in the business. And then balance sheet analysis, the main thing you're looking at is really how much working capital you've got in the business. So working capital is a measure of a company's liquidity and short-term financial health. So it's basically you look at your current assets and then you subtract your current liabilities. So effectively, it's a circle of things. So you raise an invoice, the customer owes you money, sits in debtors, but then they receive money from you. That money comes into your bank, so it's back into the bank. Then you incur a cost, that money goes out again and then comes back again. So that's what working capital is. And when you're looking at your balance sheet, I quite often compare it to a previous period to see how it's changed. So, are your main thing is cash up versus last year? Well, actually, cash is down. And here we can see it's down 39%. Okay. So really quick look at this balance sheet. I can see that the working capital overall, you've got cash of 13,000 in the bank, which is down 7,300 versus prior year. Your working capital is 8,300, so that's taking the liabilities away from the assets. But when I look into investigate a bit more, I can see that movement is cash is mainly due because there was a dividend payment during the period, which you can see at the bottom part. And also because we bought some computer equipment, and that's all fine. That's investment in the business. It's money paying out as a dividend, so there's no surprises there. Right, and also by looking at a balance sheet, this is quite critical. If you're a limited company and you pay yourself dividends, you have to make sure you have what's called distributable reserves in the business. So your distributable reserves effectively, see this capital and reserves figure. It's this 14,511 less the share capital is what your distributable reserves are. So if you have say here it would be 14,411 distributable reserves. If you said I want to pay myself a dividend of £20,000, you can't, because you don't have enough money. And that's really important, because it's illegal to pay a dividend if you don't have the distributable reserves. So yeah, if you're not looking at your balance sheet to do that, that's a big flaw. Right, so now's a good time for a coffee break. What are financial projections? This is slide 31. So financial projections are one of the key components to effective financial management. The term projections or forecasts are something that you can use interchangeably, and I will probably refer to forecast for most of this session. Okay, so by bringing together your estimated sales and your estimated expenses, you can create a forecast profit and loss on a month-by-month basis, and this will give you greater visibility to help you plan ahead, which in turn will help you be able to develop a business strategy to identify and take advantage of any opportunities that exist, mitigate any risks, set future goals and objectives, and support decision making and raise finance. So here you can see how it's all flowing together and why it's important. And I missed out to say the forecast profit and loss would flow into this forecast future cash flows. Next slide, 32. So there are 4 main steps to creating a financial forecast. So you first of all start by looking at your sales projections, and then you do the same for your expenses. And these combine to this P&L forecast and your cash forecast. And the whole process is a top-down, bottom-up approach. Okay. So you would be looking at potentially what the cost. Oh, sorry, I've just skipped forward a slide by accident. So you might realise that by bottom up, top down, what I mean is that having created a forecast for your sales and expenses, you might look at it at first glance and think, oh, doesn't look very viable, I'm not making any money. And at that point, that's when you might consider, are the forecasts realistic? Have you understated your sales? Have you overstated your expenses? What could you do to increase sales? So there's no point saying you're going to grow your sales by 25% without knowing what that's for, how you do that. But actually, if you say, if I introduce a new product and do some marketing, I would increase sales, then you can increase your forecast as a result. And this is how it all ties into this whole business planning section, because you're almost ascertaining when you need to make changes to the business to drive changes in revenue or expenses. Okay. Other things you might do is, what can you do to reduce costs, or what impact would your increased sales have on any cost? And having done all this, there might be a point where you realise, oh yes, actually, in September, this is the point where I might need to borrow some money or raise some finance, because I've got a cash hump that I need to get through. Okay, so businesses that are trading and that are able to start with a historic financial information to start their financial projections. But if you're a startup, you don't really have this information to hand. So assuming that no one's got any information, the best place you can start with is research. And typically with sales, for example, where a business might normally start with is by looking at what's the total addressable market, and estimating a percentage market share and using that to address your market. So if, for example, you are producing services in a town, you might town to 12 to 14-year-olds, knowing how many 12 to 14-year-olds are in that town is your addressable market. Okay, and it may be you say, but actually I'm going to aim to have 1 or 2%, and 1 and 2% of that percentage might be 300 children. If you know that you can support those 300 children at, say, £10 a head, that's what you would use to try and work out what your sales would be. So it has to be realistic, but you don't necessarily need to know what your current sales are. It's actually what is achievable. With expenses, again, you can research, you can ask around, find out what other people are paying. If you need to get a rental property, what rental prices, things like that. So, but it's worth knowing that no business is able to forecast their projections with 100% accuracy. But the more you understand your business, its strengths and weaknesses, the opportunities that are out there, the more you're able to create your forecast with confidence. Okay, so this is all bringing together a lot of what we've discussed in the previous workshop. So now we've covered these steps, let's delve down into the process in a bit more detail. So the Excel projection spreadsheet that I shared with you guys, it is a really simple model, and it's not a one size fits all. And with most of you, I've been able to talk through how it might be slightly different for your business. And in an ideal world, the best thing you need to do is flesh out your forecast and build it up using multiple sources of data. So during this session, I'm going to use a few examples just to really get you thinking, oh, that's how you could do that. All right. So all the time that we go through this, I want you to be thinking about how this applies to your business. Okay, so you can start putting this to context and help you with your projections. And if you've got any questions, let me know. So moving on. Just as a recap, I talked about area before, about how we acquire customers, retain them, expansion and advocacy. So this is the acronym about how you drive your sales. So what I've tried to demonstrate here is how when you add these building blocks together, the driving together, the sum of these actually keep increasing your revenue exponentially. Okay, so first of all, when someone buys from you, they don't appear out of nowhere. Their sale is part of a series of events that has helped them make a purchasing decision. So as a result of that, it's usually to do with things like sales and marketing activities, and that all costs money. So to acquire that individual person, that is known as the cost of acquisition. So if you are able to, if you spend lots of money acquiring a customer who buys from you once, you're not running a very efficient business. Okay, you're not going to perform very well. So the whole idea is to try and get more from that initial acquisition. Okay, so recap is obviously how you acquire customers, keeping them for longer. So retention might be repeat purchases, expansion might be the customer buying more from you, and advocacy is when someone's referring and you're not even needing to pay for the marketing to get them. Okay, so you might be asking, what's the relevance in terms of the financial projections? So first of all, understanding how you generate your revenue is a key part of your business strategy, as it helps you understand what changes you need to make to increase your revenue in the most efficient way and to mitigate risk. So by knowing what data is relevant to this, you can then incorporate that into your financial projections, which therefore will improve their accuracy. Okay. So as an example, if someone buys something for £10 as a one-off, the lifetime value of that client is £10. Okay. But if you keep them as a customer and they buy the same product from you every month, then you've made £120 for them just in 1 year. Okay, and you'll continue to do that until they stop purchasing. If you can then get that customer to buy, so that's the retention section. The expansion is if you can get that customer to buy more from you each time, either by upselling or cross-selling. Say they pay £20 from you every month, suddenly you're going to make £240 from them in every year until they stop purchasing. So as you can see, we've started from comparing somebody that was a one-off £10 purchase versus £240 in the year. So you can understand why this is relevant and how it makes sense to really be choosing products and services and activities that can help you develop this in your business. So I want you to be spending time thinking about how this can apply to your business. Okay, we're not going to necessarily have time to do this, but I would suggest you quickly scribble down this. I think the workshop, actually we're going to be sharing this with you, but if you make a note to think about this when you're doing your financial projections, it's worth doing. So what effectively you'd be doing is looking at how you acquire, retain and expand your clients, or not just how you do, but how you could do, because these are things, again, can help your business to grow. And if you're not thinking about how to grow your business could be quite static. And that's the point of your business plan. Okay, and then on the right-hand side, you'll be thinking about how you can measure that acquisition. And I'll give you an example. And I can see, in fact, I'll send the two slides through, those two slides through. But the main thing is to sort of talk this through in person, then we can have a look. So this was supposed to be coffee time, but we've had that, so you don't get another one, I'm afraid, sorry. So as an example, I've just tried to include a few ideas. I won't go into detail, explain what the metrics are, but if it's relevant, it's something that we can pick up in the one-to-one or separately. Okay, so with that, move to full. So with acquisition, things that a customer comes to your site, they've been referred to you, might be they've gone onto Google, the number of visitors you get to your website, it might be the number of items they put in a basket and that they then subsequently buy from you. Okay, so things that you might be measuring is number of referrals, number of visitors to your website, number of baskets, number of sales. And you might then look at the ratios of sales to basket. So of the number of baskets you've got, how many of them actually go on to buy from you? Or of the number of visitors you get, how many people actually go on to purchase? From a retention point of view, if you've got a customer that voluntarily returns to your site, or it might be the activity that you do might be you prompted them to come back to your site by sending them an email, or a pop-up comes onto your screen. So things you might measure as repeat purchase rates or retention rates or customer lifetime value. Expansion. So when a customer comes to your website, say for example, and they're looking for some dog food, you might provide recommendations, and they're things like that that are there to encourage them to go, oh, while I'm here, I'll add that dog toy to my basket. So it's just to really get people to buy. It's a bit like you go to Tesco's and there are things at the checkout encouraging you to buy and put it into your basket. And everything you do, whenever you're buying anything, look at how other people are applying these techniques to the business. And advocacy, that's just, good customer service and a quality product should in theory drive advocacy. So it's something that you should be striving for. But if you've got testimonials that you can add to your website or that you can put on social media, all that is good stuff that is helping tell people, look, I've got, or reviews on Google, for example. Okay, so what's that? So moving on, sorry, I just realised we're on slide 37, Clive. I don't know whether you're following. So having explored those different drivers that might affect your sales, let's see how you can apply that to your sales projections. So at the most basic level, you need to consider what you're selling, the cost of selling the product, the number of sales that you're expected to sell, and any trends in the market. So if you know that what you're selling is seasonal, then you'd include those seasonal trends in there. Okay. So, and then if you want to create projections with more accuracy, we can incorporate extra information to do that. But I'll show you what I mean as we go along. So, right. So moving on to the first one. So the simplified projection we have here is showing you two products. It's got strawberry yogurt and banana yogurt. And this is a simplified version, and it just assumes that you sell a consistent quantity at a set price and a set cost. In reality, we know that would never be the case. We'd expect to see seasonal trends, we might see growth, but this is just for context to show you how your projections would differ and which one's going to be more likely to be accurate. Okay, so as you can see here, it gives us our gross margin, which is consistent. And this is all linked through to that unit costing sheet that I shared with you before. So here we've got our strawberry yogurt. When we're making it to 100 components, and we've got the individual items that we use to work out what the cost is. We've said we want 50% markup, so that's given us our price. Okay, so there might be other things you need to consider in addition to costs. So if, for example, you sell things online, then you would need to include things like shipping costs. So when you're calculating that, whether you charge for that or not, you would need to incorporate it. So if, for example, you know that every postage would be £4 per postage, you would need to link that shipping cost to the number of orders you have. Or your payment processing fees, if you take payments via Stripe or SumUp, for example, that would be incorporated as a percentage of revenue. So,
sorry, Kate, can I ask about this? I tried to fill that in from a service point of view and failed miserably.
Okay.
To let it feed into how would you add service? It does say at the top, product or service.
Yeah, so you just wouldn't have any costs. If there's no cost in that service, then there'd just be no cost, and then you could. But
the price wasn't calculating. That's
no. So I think. Yeah, so what I'd suggest, if we go back to slide 39, you could just ignore the cost. You don't even have to use the unit costing sheet. You could just create another tab that just says sales price, and you could have a list of all your services, for example, and a price next to it, and link through to that. So as I say, this is a simplified model that I tried to use as an example, but you are going to need to flex it yourselves and adapt it how you see fit. So looking at this sales forecast too, what I've done is I've added just one extra layer, growth rate. So whereas the other thing was a flat thing, I've added a growth rate percentage and suggested we're going to have a growth rate of 5%. I would say that might be based on historic, or it might be based on this is what we're aiming for. And so as you can see, what it's doing is it's increasing the number of units sold by 5%. So that's the only variable that I've added to it. But as you can see, the difference here is that our revenue has gone up.
Is that a month-on-month 5% growth?
Yes, so that's a month. So yeah, I've literally put a month-on-month 5%. So you could change that percentage, yeah. But it's just as an example. So every month it's basically in the formula. And what I'm going to do is I'm going to share the example. This has all come from an example tab sheet that I put together. So I'll share it to you, and then you can at least have a look and see how it's working. So, you know, you can amend the growth rate. So say, for example, if you've hired somebody to help with sales, or if actually you put an extra 3 hours in a week to do the sales, you would expect to see that growth in sales. And therefore, that's why you've got that growth rate in there. So, you know, it's something that's linked to a change in your sales and marketing strategy. All right. So moving on to slide 41. So in this example, I've stepped up the detail again, and I've incorporated a number of different drivers. Okay, so you don't want to be overwhelmed with drivers, because in reality, lots of different things will impact the number of things you sell. Okay, but for here, as an example, I have used an e-commerce shop as an example, and I've got website visitors as a line. I've also got visitor growth rate, which I've got as this 5%. I've got conversions, so I'm saying the order. So what I've got is my visitor numbers that are growing by 5% every month. And then what I'm doing is I've got a conversion ratio, which is based on historic. That's saying, actually, I know that 10% of visitors to the website order from me. So that's converted that. And then I've said, I know that on average, people pay £10 a month, £10 each time they buy from me. So as a result, that has flown through and told me how many salespeople are going to buy and the items they're going to buy from me. So this revenue has gone up quite a lot as a result. Okay, so knowing and tracking this additional information doesn't just help you create more realistic projections. These are called key performance indicators, so things like your visitor growth rates or conversion ratios. But knowing this information allows you to recognise if the trends aren't going the right way. So if, for example, your visitor growth rate reduced, or on average people are spending £5 in your basket, you can see how that's going to impact your sales, and therefore what do you need to do to get them to spend more in your basket. And so just to demonstrate why I've included this, I've compared the 3 variations of version 3. So what I've done here is I've got A, B and C. So using that 3rd version, so the original version in year 1 has sales of 1593. So if I increase my conversion ratio to 20% a month, so if 20% of visitors buy from me, you can see that your sales from the year go from 1,600 to 2,600, I think. I can't quite see, it's not small. And then if you manage to increase the basket size again, so say, for example, in month 4, people are spending an average £15 in your basket, you can see that the annual sales will go up to £4,000. So you can see the impact that those business drivers can have on your revenue. Does that all make sense to everyone? Yep. Okay. Right. So what's sticky key? So on slide 43, you've obviously, considered when you're doing your expenses, you need to consider all the costs. So you need to consider what the cost of sales. So if you're selling a product, if you're making a product, if you're doing a service, what are the costs associated and what varies in line with your sales? The next step is working out what your operating expenses are. So these are the costs that are involved in running your business. So as a startup, if you're working from home, those costs are going to be relatively small, but think about all those costs. Are there one-off startup costs you need to include? So say, for example, do you need to get trademarks to protect your brand? Do you need to do market research? Do you need to recruit somebody, pay for a license? Those kind of things are one-off startup costs that you're not going to need on an ongoing basis. Also consider what one-off costs you might need. One-off costs tend to be forgotten about, but tend to be quite big costs. So it's really important you think about that. So it might be, if you've got a website and you need to put copy on that website so that you can drive the right visitors to your website and convert, copy on your content is what converts a visitor to buying from you. So you might invest some money, say £3,000 for someone to create your copy. That's a one-off support. So investments, if there's any capital expenditure, any equipment you need to buy, or say you need to, if you're got a shop and you need to build up your stock reserves, that's all going to sort of spend cash. And other things that you want to consider are things like annual price increases. We all know that the cost of inflation, there are price increases constantly. So if there's a natural contract renewal date, you'd expect there to be a price increase at that point in time. So we've obviously got a sales projection sheet. Rather than have a separate expense sheet, template I gave you just pulls this revenue in at the top, and then you've got the expense in the bottom here. So as you can see from the example I've put together, the monthly operating costs are running at 5,300 a month. Okay, knowing this information helps you work out the minimum level of sales you need to break even. So break even is the point where your sales meet your costs. Okay, so I've calculated your break even as 5,300, but I've worked out that because you've got a gross margin, I think in my model I've used a gross margin of 50%, for example. No, I don't know what I've worked out, but I've worked out that because of the cost of sale, I need to be making £15,000 a month to cover the break-even costs. So that obviously is when you take into consideration any cost of sale. So that's why I talk about the bottom down, top up approach. So having created your profit and loss projections, the final thing is this cash flow. The model I gave you was a very simplified version of a cash flow. It wasn't split between operating activities and investment activities and finance activities. I literally just mirrored the profit and loss and adjusted it for timing differences, so non-cash items and things like that. So really, you don't need to make it any more complex than that. But in due course, you might decide you want to change and do an indirect method. So one thing I've not included in your forecast that you'll need to consider is as and when payments are due for corporation tax. So I think I included that in your forecast, but if you don't need to pay corporation tax until you're making a profit. But as and when your business starts to make profit, you need to be making sure that you're forecasting when corporation tax is due, which we'll cover. If you want to use this indirect method of cash flow forecasting, I have updated the spreadsheet to include it. So I'll send through that financial forecast should you want to. Okay. That might also help from a consistency point of view. But the difficulty with using this indirect method is that you have to have a balance sheet, and therefore this becomes this whole complex web of having a three-way model between profit and loss, cash flow, and balance sheet. And I just think it overcomplicates things for you. If you want to really use forecasting software, there is software out there. So things like Brix, BRIXX, is something that you could actually, rather than using a spreadsheet, you could forecast all your revenue and your costs, and it'll flow through to your cash flow and balance sheet. And I think they've got trial versions, so it might be something that you try with that if you want to. And what I had included in here is if you've got an overdraft facility, you might incorporate it. So your cash at the end of the month, end of the period, was 71,000. If you had an overdraft facility of 50,000, for example, that would change the available funds of the business. So as you can see, cash flow monitoring, it's a perpetual, having a solid process of forecasting, monitoring and analysing your cash flow is key to managing your cash and critical to business survival. I'm sure you've all heard the phrase, cash is king. You can't run a business without cash. So many a profitable business has sadly failed simply because they've just run out of money. Okay, so cash flow monitoring is a circular process. So having created your cash flow, you need to understand how much money is going in and out of your business and check that you have sufficient cash to fund your operations. So as a start, when you're looking at your cash flow, the things that you need to know really your burn rate. So this is the rate at which you spend cash. So especially important for your generating revenue. So how much money you spending on your costs. Okay. The cash runway is linked to the burn rate, and this calculates the number of months you have remaining out of your current cash funds, assuming your current burn rate. So if, for example, you're not going to launch and start selling for another 8 months, but you've got £10,000 in the bank, if you're spending 3,000 every month, you know you're going to run out of cash in the next 3.5 months before you start revenue. And that's the point where you think, actually, I need to get some funding in place to help me get through the next bit. Something that other people look at is something called free cash flow, and this is the cash available after all the cash and operating activities and capital expenditure. So whilst on the whole, you should be trying to aim for positive cash inflow. Oops, sorry, just skip forward a slide. You should all be on 47. But whilst in an ideal world, you'd be having positive cash flow, there are going to be reasons why you do have negative cash flow from time to time. So if you've bought £20,000 on equipment, you're going to expect that cash flow to go up, but you need to do that. So it's not always a negative thing, but one thing that you possibly be looking at is if, for example, you look at your cash flow and you've got negative cash flow on your operating activities, but you've got positive cash flow on your investment activities, what that would suggest is that you're actually selling assets to help fund your operating activities, and clearly that's not a sustainable option on an ongoing basis. So when you've understood your cash flow, the next thing you need to do is make sure that you're managing it properly, and this is called either cash management or working capital management. So in an ideal world, business should aim to build up a reserve of cash to cover the unexpected costs. So quite often a minimum 3 months of overheads is a good base. And then obviously if you've got any liabilities or you're accruing for your tax as you go on, that's other things that you should have in base. But when you're a startup, cash reserves are a luxury that few people have. So effective cash flow management involves knowing what you can do to bring money in earlier or hold off paying people for a bit longer. So that means make sure you add your invoices from as soon as you've sold something, make sure you get that invoice straight out the door. Or for some things, it's getting money up front for things. With suppliers, it's making sure how much you owe people at any point in time. So if you're realistic about oops, can you still see the slides? I can suddenly see you all.
I think you're
yeah, you blipped out, Kate, but you're back.
Fine, okay, as long as you can see the slide. I thought, what's happened? It's good to see you all anyway. So yeah, you've got to be realistic about the revenue. If you've got a revenue forecast that says you're going to make £5,000 a month, your cash is going to be overinflated if in reality you're only going to make £1,000 a month. So that's really critical. If cash is tight, cut back on the unnecessary spend. And with stock management, if you're buying lots of products, don't overorder. Order what you need. And I'm not going to go into whole stock management, but if you keep track what if you're buying multiple products, what's selling, what's not. So don't buy loads of things that you sell once a year. Okay. Invoicing regularly and having credit checks for new customers. Make sure that they're kosher. Doesn't necessarily mean a customer isn't going to default, but at least you've done that check beforehand. And have a tight credit control process in place to get reminders out to people, let them know the invoice is there and chase promptly. This is why having an accounting system in place is really good, because they have a lot of these tools in place. If you raise an invoice, you can almost diarise to send reminders. So it could be you diarise to send an email to people 5 days before it's due saying, this invoice will be due in 5 days. Any problems, let us know. So if they've missed the original invoice, they've at least got a reminder that invoice is going to be due in 5 days. And then you can set your reminders if something's late by a day, late by 3 days, late by 5 days. That automatically chase your customers without you having to do that, which is, again, it saves time and it makes it more efficient. Make it easy for customers to pay. So if you've got a link on your invoice, again, you can get through accounting software. There's a link on your invoice to pay, and people can just click on a link and pay there and then, or sign up for a direct debit. They don't have to think about the payment and they're less likely to forget. It might mean you end up losing a little bit of money because you have to pay fees on that, but actually to have that cash in your bank might be more invaluable. And likewise, you could offer incentives or discounts to customers for upfront payment. So if you're organising an event, you could say, the early bird, if you pay up front now, you get 10% discount, that kind of thing. With creditors and suppliers, take advantage of payment terms. Don't pay earlier than you need to. So if someone's giving you 30 days and you need to hold on to that money for later, pay them on the 30 days. Don't make it late, but you don't have to pay them next week. So stretch out the terms where you can, but always pay small businesses on time. Okay, so if you've got a small business, don't take the mickey. But if they've given you 30-day payment terms, you don't have to pay them immediately. They're saying it's okay, you can pay in 30 days. And really work on relationships. If you've got a good relationship with your suppliers, you can use that to help improve payment terms, or if you need flexibility, you're more likely to get that if you've got a good relationship. And then also obviously knowing when your liabilities are due for HMRC and setting that money aside. So I'll quickly cover tax liabilities. So depending on your business, the size you are, or anything like that, if you're making profit, corporation tax will be due. And if your profit is less than £50,000, that will be at a rate of 19% profit. Thereafter, it increases, and anything over £250,000 profit pays 25%. And your tax is due 9 months and 1 year after the end of your accounting period. I don't think this is going to apply to any of you, but if you've got a large business and you're making more than 1.5 million revenue, turnover a year, profit a year, then you'd have to pay in quarterly instalments. If you're an employer, so if you pay people, you will, and your PAYE or national insurance is over a certain threshold, which usually will be the case if you're employing other people, then you'll have to pay national insurance and PAYE to HMRC. Best advice is set up a direct debit for this so you don't forget to pay, and that would normally be quarterly or monthly. Okay, VAT, if you might not be VAT registered, but if your revenue is more than 85,000 in a rolling 12 months period, so not in the last calendar year, the last financial year, but in 12 months, so we're in June now, from June to May last year, that'd be rolling, and then it would be from June to July, July to August, etc. So keep tabs on that from a revenue. So again, that's why it's important to keep those records so you can keep checking. So if you have to get registered for VAT, oh, I've got error in my slide, sorry. If you have to pay VAT, again, you can set up a direct debit. And again, it usually might be monthly or quarterly. Most VAT is paid quarterly, but you might set up a monthly basis. Some people do things on an annual basis for VAT, but I don't recommend it if you're trying to claim money back. So tax on digital supplies. I don't think it applies to any of you, but if you were selling abroad, that would be something you'd need to consider and you'd have to register. But from what I know from your businesses, it's not applicable. So, in reality, I've just had to move the slide. So, cash flow and forecasts. We've talked about cash flow forecasts. In reality, a lot of people might have to keep track of things on a weekly or even daily basis. So I know a lot of people that still keep a standard Excel spreadsheet, and they really do keep, when things are really tight, they're keeping track of when they're invoicing, they're getting dates from customers as to when they're going to get that payment date. They've got details of how much they owe, etc., and they're keeping that in Excel. So it's got to be, you've got to trust the numbers. And there are cash flow forecasting software out there, and if you've got accounting software, it will give you a very high level cash flow forecast. It may not be accurate, but at least it might give you an indication, but just sense check it. So an example that I had was I worked with a client who used Float for cash flow forecasting, and on the same day we looked, Float was forecasting that their cash was going to be £40,000 higher than it actually was. So it's got to be something you trust. But so if you use accounting software, try and use the free cash flow apps in there first of all, and that might be all you need really. So effectively, I touched on it briefly, but your financial projections are effectively a budget at the start of the period, and then as and when new information comes to light, just reforecast, and do that as, don't ignore the forecast spreadsheet that you set up ages ago, update it, because then you've got a lot more visibility as to how the business is running or likely to be running, and therefore what action you need to take. So having looked at cash flow forecasts and maybe worked out that you might have a blip, you might want to consider sources of funding. Okay, so there are lots of different funding options out there. I'm on slide 53, by the way, Clive, sorry. Almost all of these funding options will need a detailed business plan, which again is really important as to why you need to get your business plans right, and likewise the financial projections. If you're trying to get money from somebody, they want to know you've thought it through and they need to understand how your business is performing. Okay, so the main types of funding might be money from family and friends, loans, grants, equity. Angels are technically equity. I've just separated it for some reason on this slide. Crowdfunding. So family and friends, so this could be either a loan or it could be an investment. So it might be that your family or friends want to invest in your business and they'll buy some shares in the business, or they might lend you some money. It's important to understand if people are lending you money, make sure there's an agreement in place. You know, when do you need to repay that money back, just in case things turn sour. So, you know, are they expecting a monthly repayment, or is it just as and when? And is there any interest due? And when's that interest due? Okay. So, loans. So there are lots of different kind of loans. So secured or unsecured. So an unsecured loan is something that doesn't need to use your home or anything as collateral. So this makes it higher risk to the person lending you money. So it tends to be a higher rate of interest when you borrow that money. But it's a secured loan, there might be collateral on something like your house, for example, or if you're a business, it might be collateral on assets that you've got in the business. Short-term loans are something that you might need short-term. So if you have a loan, it's normally for a set period of time and you've got agreed repayments when you're going to pay that money. A short-term loan tends to be something that's like shorter term. So it might be to cover an immediate spend like an emergency. So I think there was an advert recently, wasn't there, about 6 months ago, about a loan to help buy a coffee machine when it broke in a coffee shop. So these loans might typically be shorter, for anything from 6 months to 2 years. The interest rates would be higher than a long-term loan, but if it's what you need to cover that clip, then it might be something that's worth doing. A working capital loan, again, this is something that you might have. It's a bit like, it's another short-term loan, but it's when you have a short-term funding need to cover working capital squeeze. So invoice financing, so that is a form of secured finance. So the security being on debtors. So for example, rather than waiting for customers to pay an invoice, if you need access to cash relatively quickly, you hand over the invoices to a lender, and the lender effectively offers you a loan up to a percentage of the value of invoice, which you then repay later as and when you receive the money. But this allows you to typically access between 70 to 90% of the invoice value. So if you know that somebody's not going to pay you for 90 days because they're adamant about that, you know you're going to get that money in, that might be an option you decide to take. So obviously the amount you borrow through invoice financing is obviously linked to how much of your unpaid invoices you could have. There's also invoice factoring, invoice discounting, so all different things you can explore. Asset financing, so if you need to buy assets for the business, rather than waiting until you've made enough money in the business to make that investment, asset finance allows you to make that investment sooner rather than later, so you can start driving that business growth. And that might be either an operating lease, which is treated as an expense in your profit and loss, or it might be a hire purchase agreement where you own the product at the end of it, in which case you recognise the asset as a capital expenditure, and the other side of that is a liability that you repay every month. Credit lines or overdrafts, so this is quite a flexible form of finance. So rather than applying for a fixed sum of money, you might agree a line of credit that you can borrow as much as you need, and you only pay interest as and when you use it. So a lot of people call it revolving credit facilities, might be something you've heard of, or overdraft. So yeah, just as and when you need it, you can dip into it, and they could be either secured or unsecured. It'd be depending on who's lending the money. I've not listed on here, but there's something called merchant cash advances. These tend to be things like if you sell items on Amazon or Shopify, for example, they've started to lend money to businesses, but instead of paying a regular loan repayment, the loan is repaid via the credit card transactions you make. So if, for example, you're selling items via Shopify, they would just keep, say, 5% of your sales every sale you make until it's repaid. And then we've got government-backed loans. Right. So in terms of government-backed loans, just give you a bit more information here. Something you can apply online. So I've given you a link. You can go to gov.uk or just search apply for startup loan. If it's via the British Business Bank, it also includes 12 months of free mentoring, which means you can continue to get business support after this programme, which seems a no-brainer to me. You can borrow, I put 500 to £250,000, and you can repay it over 1 to 5 years. It's a fixed rate of interest, and effectively the government is backing the risk, because you as a startup, the government is backing those loans. And you have to be trading less than 3 years. After that, you're not considered a startup, and you will need a business plan. So this other link that I've got in here, if you click on it, it can give you different suppliers that can provide this business loan. Right, grants. So I'm going to be deliberately vague here, because obviously the market for grants is ever changing. Okay, so a grant, where there's a loan, you need to repay that money back. A grant, you don't. Okay, which is great. And if you search in Google grants, or here I've given you some links on government, you can find government grants, you can funding finders, all these things, you can search for different grants. And when I say it varies constantly, an organisation, or say for example the council, or it might be something to do with energy efficiency, there will be grants at certain periods of time that they're trying to encourage businesses to invest, to do things X, Y, and Z. So if you can find those grants that are relevant to your business, the economy is trying to support businesses like you. So constantly be looking for what grants are available. A lot of people spend a lot of time applying for grants and actually spend, but it's invaluable, because that money, as Kieran said, Kieran's got a grant recently, and that's going to help him with the next part of his work. But yeah, just literally look online and you can start finding a whole range of things. They are treated as income. So if you get a grant of £10,000 and you only spend £2,000, you will be taxed on that profit. But they are not, you don't have to pay VAT on there, they're outside of scope of VAT. Depending on who you get your grant from, some grants are a bit stricter in terms of keeping track of the spend. So you have to be very specific about why you want the grant and how you're going to spend that money. And some organisations will want you to come back and say, this is how much we spent the money. Others aren't, and it's just, here's the £3,000 you've applied for. It wouldn't be cost effective for them to do it. But big players like Innovate UK, for example, they might give you a grant of £100,000, but they want to know exactly what you spent that money on, just to make sure that it's being used properly. And if you don't use that full £100,000, you would have to pay that money back. So again, it depends on the grant. So every grant is different. Equity. So equity is basically where you issue shares in your business in exchange for cash. Okay, so the advantages of equity is you've got no loan to repay. It helps if you've got a poor credit rating. Also, usually when you sell shares in your business, it's usually with an investor who's got vested interest in helping you grow the business. So you can normally learn and gain experience from them, and you've got somebody that effectively is going to help you grow the business. The disadvantage is that obviously you're going to be sharing a profit, the value of your business. You might lose control, an element of control, but in reality you shouldn't do, and there might be potential conflicts as to how you run the business. So there are different types of equity raises depending on when your size of your business. So if you're a startup, it might be something we refer to what I call pre-seed. So that's when you're a startup, you're developing product and doing market research. If you've got a product but you're refining it, or you're developing a concept before bringing the product to market, that might be known as a seed raise. When you're raising a bit more money, or you're revenue generating, that's known as Series A, and it goes on to Series B, where we're talking significantly bigger businesses. They're revenue generating, they're really looking to scale up. And a Series C might be huge potential and an IPO is on the horizon. So probably not going to be relevant for any of us, but it's good to know. Just sorry, Siri's talking to me background. But yeah, there are different types of equity investors. I'm not going to go into great detail. So it could be individuals. So it could be a friend or relative, as I say, that says, actually, yeah, I'm going to lend you some money, but rather than you owe me money back, I'll have a 5% stake in the business. Angels are what I call high net worth individuals. So they might be ex-entrepreneurs that have made money and they want to help support other businesses, but also they will get a share from any success that you bring. So they'll bring experience with them and they obviously want you to grow. So they'll bring any what they call the black book and relationships with them. So if you do get an angel investors, find out how can they help you grow? What can they bring to the table at the same time? It's not just about them giving you some money and then generating revenue. But to find angel investors, it's a lot of networking. So it might take quite a long time for you to go out, find those investors, build up the relationships, because an angel investor needs to know that you've got what it takes to drive the business. You know, it's all well and good having the business plan, but if you don't have that drive to create, or you haven't thought it through, then the angels will see straight through you. Okay, and they typically want, I don't know, maybe between 10 to 25% of your business. Venture capitalists, a bit like angels, and they also support early start businesses, but they tend to be unlikely to come in before a seed stage. They aren't individuals, they tend to be investing funds from pensions and they're looking for a return. So venture capitalists and private equity, they'd typically be looking to exit the business in 3 to 5 years. So if you're not looking to sell your business, you're unlikely to be able to get venture capitalists involved. Okay, and private equity I've included in here, they just tend to be the next level up from venture capitalists. But venture capitalists and angels, they're all a form of private equity, but it's not a private equity firm. One thing that's worth knowing is that there are tax relief for investors. So if you are a business that's less than a couple of years old, you can apply to either something called SEIS, SEIS, or EIS. And what that does is it, as part of the application, you can get tax relief. So if you've got an investor in your business, they get tax relief on their investment, like an exponential. So it's worth doing. So if you're trying to encourage somebody to come along, by getting that tax relief, that's a good incentive for them to invest in you. And likewise, if your business for some reason fails and they lose that investment, they can then get tax relief again. So finally, moving on to crowdfunding, which is the last thing I want to cover. Crowdfunding is an alternative method of fundraising, and it's not a new concept. It's been going for quite some time in all shapes and forms. I think Marillion used crowdfunding to help fund a tour one year. But basically, crowdfunding enables you to collect money from a large number of people via an online platform. So rather than raising a big sum of money from an angel investor or from a venture capitalist, crowdfunding, you might have 1,000, 2,000 people all investing £10 in your business. Okay, and it's quite often used by startup companies, and it's a good way of growing a business, you know, accessing funds without possibly the same amount of time effort is required. But it's not an easy task when you're crowdfunding. You can use it as part of your marketing strategy, because when you're doing crowdfunding, a lot of it is you don't just put your investment on a platform and say invest. You've got to go out and shout about it. So you need to do lots of marketing and social media, sharing with people and just drumming up the crowds to get on board. So you do have to put the work and spread the board. So crowdfunding and backers, what do they get from it? So usually there's usually an incentive, and you tend not to get people just giving you £10 investment just for the sake of it. They normally want something in exchange. So it might be, for example, it's the opportunity to become an early adopter of a new product and the opportunity for them to input and say how that product is developed. So that might be, if you're a gamer, you might want to be involved in a gaming platform and you're one of the key people involved in that. It might give you the opportunity to pre-order a product and have a say in its developed. It might give you exclusive rewards like an early bird discount as and when they do launch. Another type of crowdfunding, you do get things called equity crowdfunding as well. So and I will cover that. So I think Seedrs, for example, is an equity crowdfunder. So again, that's a good way. If you need to raise, say, £100,000, for example, you would be you offering equity investment, you can do that. But it's interesting with things like all these crowdfunding platforms, invariably when people start, they usually have a significant backer involved before they do that. If you launch a crowdfunding platform and you've got no support whatsoever, a lot of people are hesitant to invest because they think, well, actually, is this something that's worth doing, and what happens if no one else invests, etc. So quite often it might be that you've got a family and friend that might want to put 5,000 in the ring. You put that in your crowdfunding pot and you might say I'm halfway there, and it encourages more people to get involved. Was there anything else I was going to say? Oh yes, sorry, go back to that slide. So yeah, I mean, usually crowdfunding platforms have fees if the campaign is successful, and many sites have an all or nothing. So if you don't raise the money, it may be that everyone who's invested gets their money back, you don't pay anything, etc. So it's worth exploring that and looking at how they vary. As say, Seedrs is the equity crowdfunding, and it's quite attractive option. So I've invested in a couple of things on Seedrs. They've all had SEIS, so that's meant that I've got some tax relief at the end of the day. And other examples of crowdfunding that I've been involved in. First crowdfunding thing I did was a lady who was trying to print a book. So there was obviously the initial printing cost of doing so. And as a result of my investment basically bought me the book. So it allowed her to kickstart that process. Everyone who did it got the book, and then she was able to continue producing. I've also got another one, which is via Kickstarter, which is a coffee making machine. That's been going on for about 2.5 years. We still haven't got the product. But there's risk. Just because you invest doesn't mean you're going to get that. So I perfectly accept it. They have released the product. So it's just a question of it coming in place. But if you're investing in something expecting to definitely get something, there is a risk that you don't do that. And the final thing that we've crowdfunded recently is Gulp. And Gulp is a machine that works with washing machines, and effectively it takes out all the sort of rubbish, the plastic rubbish that's normally in a washing machine, and it extracts that. So that's a really exciting product. And even if we don't get that product, knowing that we've been able to help those businesses do that's been great. But as I say, it's an investment, there's a risk to everything. So the final bit of advice, I don't know whether you've heard of the FSB, which is the Federation of Small Businesses, which if you're not already members, definitely worth having a look. You get lots of great, for an annual fee, you get lots of great benefits. You get discounts on things, you can get legal advice and things like that, insurance things. But they have got a platform called the FSB funding platform, and it gives you access to the largest number of business lenders in one application. So you can type in what your funding need is, and it will come up with potentially all the people that can provide that support. So rather than you spending hours doing that research, it's quite a good way to be able to do that. So that brings us to the end of the session. Hope you found it useful. Has anyone got any questions?